Live from New York City for our audience worldwide, Bloomberg Real Yield starts right now. Coming up, Treasury yields surging higher as employment costs climb by the most ever, just ahead of the Fed's next move. We begin with the big issue, looking ahead to Chairman Powell.
The Fed does have a very difficult job right now.
We've been on this roller coaster.
At the May meeting, you're going to start to lay out more of the plan.
We've definitely had a very concerted pivot, shift, lean towards the hawkish direction. As inflation continues to run strong.
How much you're going to go on rate, how much you're going to move the balance sheet.
People are heavily fixated on where rates are going to be.
We're expecting 250 basis point rate hikes at the next two Fed meetings.
The Fed is in warp speed in terms of trying to get to neutral.
I don't think anybody knows what the neutral rate is.
2.25, 2.5, maybe a bit higher.
They're going to have to go through a process of price discovery.
The real question is, can it pull down demand enough?
The path to a soft landing for the Fed is narrowing.
That's going to be challenging.
Patience is at the top of my investment pyramid today.
Let's get to the panel. Joining us now is Morgan Stanley's Matt Hornbach, BlackRock's Bob Miller, and Kathy Jones of Charles Schwab. Kathy, let's begin with you. What are you looking for next week?
Yeah, I mean, I think it's a foregone conclusion the Fed goes 50 basis points. They've signaled that pretty strongly. I don't think 75, although there's been some speculation on that, is likely. And then they'll signal more hawkishness and more rate hikes ahead. I think that we know what the balance sheet situation is going to be already, but there may be a few surprises there.
Matt Hornbach, where is the potential for surprise?
John, I think the potential for surprise really is in the press conference. Chair Powell has been pretty clear, really since January, that the key priority for them is to get their policy rate up to neutral as quickly as possible. I think if he suggests that moving that policy rate above neutral is a new priority, that would be a surprise to the market. But otherwise, I agree very much with Kathy.
Bob Miller, you said something that really caught my eye. You said the Fed does not have the luxury of being data dependent right now. Bob, what did you mean by that?
Well, Jonathan, I just think that they realize that they're a bit behind and they really need to have a very high sense of urgency for the next several meetings to get moving and get the funds rate moving with some sense of urgency, right? And I think that means 50 basis point increments at each of the next three meetings. And if sequential inflation, if month-over-month inflation starts to annualize something more like 3% instead of 6%, then they've got some breathing room in the second half of the year. If it isn't, decelerating at that type of pace, I think it's going to become much harder in the second half of the year. So they're in a box right now where they need to get moving. I think they will do so. They'll leave all of the hawkish options on the table for the time being. It's simply too soon for them to remove any of them from the consideration.
Bob, just build on the glide path for inflation. Some of this is quite mechanical, based on the base effects of the year-over-year figure and the fact that some of this is just going to come up in a number. We'll see it decelerate. We will have a mechanical peak in year-over-year inflation. Bob, when do you start to see that really hit in a more pronounced way?
It's coming right now in the second quarter. The monthly prints a year ago were very large. We will see meaningful deceleration in the year-over-year over the next 4 to 5 months. The question is the sequential run rate, is the run rate through the summer into the fall actually suggesting a durable decline to 2.5% to 3.5%, or is it still suggesting on an annualized basis that we're going to be printing something closer to 4%? I think that's the big question in the market right now, and we simply need some time and some data to begin to answer that more clearly.
Kathy, I agree with Bob. I think that's a major question on how the Fed's going to respond to this decelerating sequential story through the summer. How do you expect them to do that?
Yeah, I think they will do the best they can to message, what they're seeing. But frankly, I don't get the sense that they have a tremendous amount of confidence in any of their forecasts now. So if you look at the dot plot, the next time we get the dot plot, that dispersion is going to be very, very wide, right? And so you've got, the likes of James Bullard, who wants to go very, very fast. And then you've got others who want to take a more measured approach. And I don't think in this environment it's going to be easy to predict where inflation is going to land by December. we're going to just have to wait and see the numbers, and I think that they'll react to them as they come along.
Matt Hornbach, what's your read on this?
Yeah, John, I completely agree with both Bob and Kathy on this. I think ultimately those month-over-month prints, as we make our way through the summer, are going to be key. You know, we'll also be paying very close attention to the trimmed mean measures of month-over-month inflation, which have already peaked at the PCE index level, in core PCE index level. So I do think that's important. And also, you know, just on the 50 basis point versus 75 basis point issue that Kathy alluded to earlier. I mean, look, a 50 basis point pace of rate hikes is plenty to get the funds rate up very quickly. That's a 400 basis point per year pace of rate hikes. 75 would, I think, really send a message that the Fed is scared, and that's not what the central bank wants to make everybody believe at this point.
Matt, we get to what they think is neutral pretty quickly. That's where the consensus is. Let's get there. 225, 250. Once we're there, Matt, that's where there's division on this FOMC. What do you think settles that debate about what you do next once you get to what they think is neutral?
Yeah, ultimately, I think it is inflation and how the global risks are developing. I mean, we can't forget that, you know, we live in a global economy. The U.S. is insulated to a certain degree, but also, you know, going back to what we saw in 2019 with the trade conflict between the U.S. and China, it ultimately did end up having an impact on the U.S. economy. So we can't completely forget about what's happening outside of the United States. I think a combination of what's happening with inflation here at home, as well as what's going on in Asia, what's going on in Europe, all of those will factor in to, I think, ultimately where the Fed ends up coming out on that debate.
And ultimately, Bob, what happens with growth? At the moment, they don't have to choose. They might have to choose at the end of this year between supporting growth and accepting prolonged inflation above target for maybe a longer period of time. Do you anticipate that will be the decision, the dilemma they have to face in the back half of this year?
You know, it's definitely possible, Jonathan. I think that's the direction of travel. I mean, you know, almost definitionally, they need to put that on the table, right? They need to get the funds rate up, and they need to have sufficient tightening of financial conditions domestically, such that we can test the durability of the labor market specifically. I think we think it's going to be pretty durable. We think that underlying dynamics in the labor market remain pretty robust. No doubt the pace of job growth is going to decelerate some because it's been so high for a while. But you'd have to really shake the labor market. I mean, you know, push the unemployment rate up 2, 3, 4 tenths or something, I think, in order to get their attention. If inflation, as Matt said, if inflation remains broad and it's still annualizing at something like 3 to 4 in the second half of the year, they're going to have to accept some growth slowdown in order to get that down to something more like 2 to 3. I don't think they're targeting 2. I think they'll be happy if inflation is sub 3 in 23. But it needs to be on that run rate in order to get some comfort.
We're having this conversation on a day where yields are surging higher again, getting back close to the highs of the year, and the equity market is breaking down. On the S&P 500 down by more than 2%, on the Nasdaq down by 2.5%. This month has been terrible for equities. For the Nasdaq 100, we're down the most on a monthly basis since 2008. Kathy, is the Fed put dead or alive? How are you thinking about that dynamic, this Federal Reserve, and how it responds to what happens in this market?
Oh, I think it's dead. But I think the question is not just how the equity market performs, but how much financial conditions tighten. Equity performance is a part of that equation. So we have a lot of dynamics already where it looks like the anticipation of Fed tightening is actually tightening financial conditions a lot. So the decline in equities, the strength of the dollar, compounded by widening credit spreads. I mean, we've got a lot going on already, and the Fed's only hiked 25 basis points. So as we get into the second half of the year, I don't know that it's a choice between, if the Fed is worried about the markets, unless it's illiquid or there's some problems, but the global economy slowing down, the tightening in financial conditions worldwide, and further rate hikes being signaled, that's going to create a real problem for the markets and for the Fed.
Matt, how would you frame this? Because the other problem they have is that if they do anything less than what is already priced, that effectively is an easing of financial conditions. So, Matt, how do you think they respond to the market developments of the last few months?
Well, John, I actually think they're probably tickled pink that financial conditions have finally begun to tighten. I mean, there was a period earlier this year where it looked like the equity market was invincible. So I do think that they probably are satisfied that we are getting some tightening in financial conditions. And I think it's worth noting that, to Kathy's point, it's not just the equity market. You're also seeing real interest rates in the U.S. rise. The dollar has been on a tear, an absolute tear over the course of the past several weeks. So we are getting a variety of financial markets that are contributing to that tightening in financial conditions. As for whether the Fed put is dead, I mean, I think it's just in hibernation. Ultimately, there is a level where the Fed will react. It's just we're kind of far away from that level at this point, John.
Bob, where do you think that level is? You got any idea of where that might be?
No, I think the strike price has moved considerably lower than where we thought it was just a couple of years ago, or certainly a year ago. But again, it's conditional, Jonathan. It goes back to the question you asked, which is it's a function of are we seeing pressure on labor markets, right? Is our job growth slowing and unemployment rising? Is inflation, does inflation end up being a bit more persistent than expected? And it creates real tension for the central bank. They have blunt tools, and they're no doubt they're going to try to use them as efficiently and effectively as possible, but this is going to get tricky. Financial assets have been, as my colleague Rick Reeder likes to say, you don't pay us to hold cash, but boy, cash looks attractive relative to anything with duration or equity risk at the moment.
I hear a lot of people talking about cash. We'll talk about that next. Relative to credit, Matt Hornbach, Bob Miller, Kathy Jones sticking with us. Up next, the auction blog. Europe recording its first high-yield bond sale in more than 2 months. That's next. This is Bloomberg. Live from New York City, I'm Jonathan Ferro. This is Bloomberg Real Yield. It's time now for the auction block, where we kick things off over in Europe with Miller Homes selling high-yield debt this week, marking the first European junk bond sale since early February. In the US, volatility limiting junk bond sales to $11 billion this month, the slowest April going all the way back to 2009. And 2 US high-grade issuers coming to market on Thursday, Waste Management and Amex, boosting weekly issuance to $8 billion. Sticking with credit, Mark Kiesel at PIMCO, making the case to stay defensive.
We have been favoring airlines. We've been favoring lodging. We also like banks, financials, and also apartment REITs, basically getting cyclical risk down, getting a lot of subordinated credit risk down, and basically sitting in cash, sitting in the COVID recovery sectors, and also in non-cyclical defensive sectors. So defense sector, cable, telecom, healthcare. We've been reducing credit risk. We've been reducing for seven months, and we've been building up this cash. It's up to 10, 12%.
Kathy, you're turning cautious on credit. You agree with some of that. Why?
Yeah, I think the challenges ahead for credit are just immense, and the yield compensation or the spread you're getting just isn't high enough. When we look at the challenges from peak profit margins, the continuing rise in costs from energy, say, or input costs and labor, that's going to weigh on profit margins. And then the global situation, certainly not easy, and the Fed tightening on top of that. It's just very hard to make a bullish case from here. And also, those spreads have widened a bit. We don't think they've widened enough, really, to start to ease up on our kind of cautious stance. So we're particularly focused on being more defensive and high yield. But even in investment grade, I sort of like the single A's better than, the triple B's here. I think you just have to move up in credit quality and wait it out.
Bob, big picture, do you agree with all of that?
Yeah, absolutely. I think for the time being, up in quality, more defensive posture is appropriate. In some pockets, we are getting to yield levels, all-in yield levels. I agree that spreads haven't really moved much. But we're getting to all-in yield levels, AA CLO, where you can source stuff in the, mid-4s to low 5s. I mean, if you have the capacity to underwrite the underlying collateral well, some of these yields look reasonable to us. You fast forward to a couple of years from now, I think inflation will be eventually below 3%. And you can start finding some positive forward real yields that are in the 2 to 3% range for reasonably high quality, intermediate duration kind of stuff. I think there's some value there.
Bob, relative to the spread widening we've seen in the not too distant past, what do you make of what has happened and why it has been so contained over the last year?
Because the underlying growth story has been solid, right? So the corporate cash flow dynamic has been superb. Yes, companies have been faced with rising employment costs and input costs, but they've been able to pass those along. So margins haven't really degraded over the past year and a half, and the underlying growth picture in the U.S. specifically remains reasonably resilient, such that no one's really begun to consider whether we'll have defaults, even in the high yield space. I mean, the quality of the high yield market in the U.S. today is pretty high relative to a longer term observation of quality in that market. The likelihood of defaults in the next year or two is very, very low, absent some kind of shock.
So, Bob, is that the right way to think about the next year or so, or do you just not like the price of the story? I'm trying to understand whether you anticipate the economy breaking down a little bit from here, or whether you just think things are too rich relative to the risks out there.
I think in the intermediate part, so let's take the 5-year point on the curve. I think you can source and comfortably own some high quality credit risk. Again, you can create a portfolio that has a 4.5% to 5% yield of reasonably high quality securitized credit and some IG type stuff. I do think rates are going to go higher still, especially. I'm more concerned about the term structure of rates moving higher. It's a different topic, which I think we'll probably get to with respect to kind of the global term premium channel. But the intermediate structure in the U.S. with forwards where they are, it's starting to look, okay. It's not cheap, but it's no longer ridiculously rich.
Matt Hornbach, your assessment of things, please.
Yeah, well, I completely agree with Bob. I think we've had a pretty decent cheapening, and some of these real yields. Yeah, I mean, even in the Treasury market are starting to look more reasonable from a longer term perspective. The 1 year forward, 1 year real yield in the U.S. is very close to zero, and some people would consider a 0% real yield to be a neutral level. So we're definitely more reasonably valued. With respect to why credit has performed reasonably well, again, agree with Bob. Another technical factor I think is worth noting is what we're seeing happen in the corporate pension fund industry. Their solvency ratios, the funded status, the relationship between their assets and liabilities has improved dramatically over the course of the past year. And so I think there have been a decent amount of flows out of equities and into longer duration corporate bonds, which may have been helpful to that market. The final thing to say, John, is that we've had in terms of corporate credit, we've had a really decent cheapening in one of its competitor products from an ag perspective, which is agency mortgages. Agency mortgages are looking obviously much more attractive today than they were at the beginning of the year. And so that's a consideration, I think, that corporate credit is going to have to deal with at some point.
What this universe is competing with, and Kathy, I wanted to finish there. Do you think 2.5%, 3% on Treasury yields is really the thing that breaks Tina?
Oh, yeah. I would agree with both Bob and Matt. You're starting to see yields in the intermediate term area of the curve that are pretty attractive relative to where we've been for a very long time. And when I start to look at the whole spectrum of credit relative to, say, where dividend yields are right now and the prospects of what might happen with further Fed tightening, I think there's plenty of alternative to Tina. I think you just have to be kind of cautious and pick your spots.
Kathy Jones, Matt Hornbach, Bob Miller, sticking with us. We'll look ahead to the week ahead. The final spread coming right up, featuring a Fed rate decision and a payrolls report in the United States of America that we have hardly talked about. 390K is the estimate on my screen right now. That's a moving target. The previous number, 431. That's next. This is Bloomberg. Live from New York City, I'm Jonathan Ferro. This is Bloomberg Real Yield. Wrapping up the month of April, wrapping up the week as well, with the Nasdaq down by more than 2 percentage points on the session. On the month, we're down almost 12%. On the year, we are down on the Nasdaq 100 by almost 20%. Going into a massive week for equities and bonds alike. For the bond market, the employment cost index lighting a fuse underneath yields at the front end going into the Fed next week. If you thought this week was big, next week even bigger. A host of central bank rate decisions on deck, including the RBA and the Bank of England. Then on to the big one. We get a rate decision and Chairman Powell news conference on Wednesday. PMIs out of China, Europe and the United States, and rounding out the week with the US payrolls report this coming Friday, a week from today. Let's get to Matt Hornbach, Bob Miller, Kathy Jones for the rapid fire round. You know how this works. 3 quick questions, 3 quick answers, and let's start with this one. Where does the Fed peak this hiking cycle? Just pick a number. Matt Hornbach.
3 1/4.
Kathy Jones.
275.
Bob Miller.
I'll take the middle, 3%.
There we go. Second question. High yields from where they are now, spreads wider or tighter by year end? From here, wider or tighter by year end? Bob Miller.
Wider.
Kathy Jones.
Wider.
Matt Hornbach.
I'll go with tighter.
Tighter. Interesting. Final question. Are you just doing that to be controversial? 2s, 10s. Right now, where are we? Let's get 2s, 10s up on the screen. On my screen, 2s, 10s at about 20 basis points. Call it 19. Steeper or flatter by year end? Kathy.
Flatter.
Bob.
Steeper.
Matt.
I'm going with flatter, John.
To the 3 of you, thank you so much. Going into a big week next week. Matt Hornbach, Bob Miller, Kathy Jones from New York City for our audience worldwide. That is it from us. We'll see you same time, same place next week. This was Bloomberg Real Yield. This is Bloomberg TV.